I want to assure you people and assure the country, the economy is now on.
Honorable, do you want...
How's it going, folks? We have just been rugged once again, if you can imagine such a thing, on key employment data out of the US. The markets don't like it, the Fed don't like it, and the chances of a rate cut at the December meeting have absolutely plummeted. All that being said, markets are holding up pretty well considering, but the picture that this paints of the future unfolding in months coming from here doesn't look great. So we're going to break it all down. You need to be paying attention to this because this is pretty groundbreaking stuff, pretty unbelievable stuff coming out of the US. We're going to start, as always, with Bitcoin pricing because we have, in fact, bounced somewhat, right? Currently trading at a price of $91,988. We broke, feels painful to say this, but we broke 92K earlier today. Of course, the new low on the chart here, Coinbase Spot, is coming in at 88,432. Just holding that level now. Okay, there does seem to be a floor appearing down at these sub 90k levels, but the picture looks pretty grim overall. We can't sugarcoat this. Obviously, we're also holding below, well below, in fact, that 50-week moving average, which is a lot of people's line in the sand for bull market lows. Once again, on the higher time frames, percentage-wise, this move down isn't terrible, but clearly the market structure is just really weak at the moment. If I move that back onto the hourly, actually, I mean, you don't need to be an expert technical analyst to see why this chart pattern just looks weak. Okay, it's just down and to the right at a pretty steady rate, a pretty steady bleed over the last few days, unfortunately. But that is the situation that we're in. S&P actually holding up much better than expected today. We're up from lows some 2.42%, which is particularly surprising given the situation that we've got going on in the US. So first of all, rate cut chances at the December meeting have plummeted to sub 30%. We were looking at nearly 50% yesterday. And I think this is almost entirely due to us getting rugged once again on the employment data coming out of the US. So two important headlines that we need to cover here. First of all, the BLS, Bureau of Labor Statistics, says that the full October jobs data won't be released. It's never going to be released in full. What they do have from that, the available figures, are going to be included in the next report in November. But this gets better and more unbelievable because that November report is now going to be delayed until after the December Fed meeting. October jobs report cancelled and November release delayed, says the Bureau of Labor Statistics. Now, bear in mind that Goldman Sachs have their own numbers on what the October data report should be, and they estimated that the US likely lost 50,000 jobs in October. So this whole thing, when you paint the picture in the broader context of Trump firing the former lead official on at the Bureau of Labor Statistics, right? This was a headline back in August. Okay, Trump fires lead official on economic data as tariffs cause market drop. This whole thing is starting to look more and more suspect. Basically, what I'm getting at is it's looking like that October data isn't going to be released in full because it is so bad. And it's so bad in contrast to the September data that we can't be seeing it. I think they're also worried about the November data, which should usually be released prior to this December Fed meeting, right? And then would therefore directly impact what the Fed decides to do with the interest rate at this December meeting. So the Fed is once again flying blind. We are going to get that September data release in just a few hours from now, depending on when you're looking at that, when you're watching this. That's going to come out at 8:30 a.m. Eastern time on Thursday. And essentially, the Fed doesn't like it. Okay, once again, the Fed is flying blind. They're flying without data that they need to make these rate cut decisions. You might be asking, why is the market up despite the fact that we've got lower chances of that 25 basis point rate cut? There's now a 70% chance that they're just going to hold interest rates at that 375 to 400 level. And I think what's going on here is two things. First of all, we had some big tech earnings releases today, Nvidia in particular, beat expectations. And we know that these mega AI tech stocks are a massive outliers in the S&P. Okay, so they drag the whole index up with themselves. It looks like we're not yet close to that, or not as close as we thought perhaps, to that AI bubble bursting. The second thing is I think it's likely that investors are basically digesting this information and taking it as, okay, well, we're not necessarily, we don't necessarily know how bad the situation is. Therefore, the situation is kicked further down the road. Okay, so the reason why the Fed would be less likely to drop rates further, less likely to give us another 25 basis point rate cut, is because that data isn't so bad. So I think we're in this strange situation where it's assumed that October's pretty bad. It's assumed that November might be bad, but we don't know. And you've got this weird scenario where, although we are less certain, markets classically don't like uncertainty, we don't know how bad that situation is yet. Therefore, the decision is kicked further down the road. And as that rate cut isn't coming in yet, we've got a better chance of holding that. Markets are kind of pricing in a hold of the interest rate decision, because in the moment, or at least in the time frame of rate cut to rate cuts decision making, we're in a situation where the economy isn't looking quite so bad long term, at least on the data that we have right now. But if you, again, consider the facts of why is this data being redacted, why aren't we getting it, why is it being delayed again and again and again, it seems to be a different story every week. That paints a pretty grim picture about the future of the US economy right now. And again, that can play into the positive side for Bitcoin and for crypto if you're a believer in this long term. But as always, that is a long-term view. Okay, it's not financial advice, of course. I had someone contacting me today and asking, is it time to start exiting? And the answer to that question, in my opinion, purely in my opinion, is no. It's absolutely not the time you want to start dumping your bags if this is something you believe in. Okay, if you were to sell your spot holdings now, you're essentially selling out at prices that we haven't seen since before January 2025. So you're basically selling into the red, selling on red days, selling in the reddest of red days, which is typically not a great idea, not a great strategy if you're someone who's in this for the long term. Now, of course, that completely doesn't apply to situations where you're over leveraged in short-term positions. But if you're looking at this from a bird's eye view as an investment over the next 5 to 10 years, or the next multiple cycles, then selling today is absolutely not something that you want to do. Of course, no recommendations here, not financial advice. Once again, we know that there's a lot of leverage in this market. We know that there's a lot of short leverage in this market right now. And I mean, take this point with a pinch of salt, okay? Because it's not the entire story, but basically whichever side of this picture, okay, this is the, in fact, let's go down to the total Bitcoin market. This is the exchange liquidation map. This shows us where the cumulative liquidation risk lies in the market. Right now, this is showing us that there are a lot more shorts in the market than there are longs. In fact, this is about double the risk that we were looking at yesterday, right? $8 billion worth of short liquidation risk versus about $2.5 billion worth of long liquidation risk right now on the 30-day time horizon. And usually, whichever side of this is bigger is wrong, because generally, traders who are under liquidation risk aren't making rational decisions. They generally just get wrecked in this. So even if we did rotate into a bear market in the macro sense, I think it is more than likely that we see some sort of relief bounce from this, probably or very well potentially on release of that September jobs data and whatever the aftermath of that is, however the market absorbs that. History has just told us that usually when most people are betting one way, the market remains irrational and goes the other way. The market can remain irrational longer than you can remain solvent. And a story here just to highlight that point, okay, about people being over leveraged, people getting wrecked for no good reason, right? If you're getting margin called and if you're getting liquidated, you're not in the game anymore, so you can't be winning the game. Grinder owners scrambled for private buyout after stock crash. So essentially, the majority owners of Grinder are all facing margin calls right now because they were taking out personal loans collateralized by their stock holdings. So now they're getting margin called, potentially liquidated on their own stock, right? Leveraged on their own stock. This is a scenario that isn't just acted out by casual retail traders. And that's why you see it represented in the data like the Bitcoin exchange liquidation map. But there we go. We're about 8 hours, maybe a little bit less than that, depending on where you're watching this, from that September jobs data coming out. The chances of that rate cut are pretty low right now. I think if we see positive data on that September report, we might well see a further pump in risk assets. We might well see further recovery in Bitcoin, despite the fact that that rate cut decision is reduced. But honestly, at this point, it's things are looking very much in the balance long term, because we just hear a different story about the remainder of this jobs data every day, it seems. But there we go right now. Uncertain times for sure. No, I'm not selling out of spot bags. Certainly not at this point. Once again, just to hammer the point down, okay, we're currently down from all-time highs about 27%. We've been here before twice in this run-up, okay? And in fact, much less both times. So minus 31.5% back from the highs put in March 2025. And after the highs put in March 2024, we came down about 35.5%. Yeah, I won't be selling the bottom on this one. And again, if you have a long-term accumulation strategy, you want to be averaging in on days like this when the market is down, on weeks and months like this when the market is down, because the odds of you timing the actual bottom of any significant move are so slim, it's almost not even worth trying. Statistically, it's not worth trying. It's worth just averaging in, and then you will win on average overall. But there we go. As always, just my ramblings, just my opinion shared with you purely for entertainment purposes. Nothing I say should be considered financial advice. Thanks so much for watching. Plenty more to come. Bye.